All right, so this is John Darwin, and I am not your financial advisor. And today we're going to be watching Ben Felix on YouTube. I love this guy. I've been watching his stuff for maybe 2 weeks now, and he's just a wealth of knowledge. He's a portfolio manager. I'm a financial advisor, just not yours. And he's way more of a brainiac than me. Not going to lie, he's way smarter than me, but I am more boots on the ground, probably dealing with mainly retirement planning, retirees, people leaving the workforce, and we're gonna pit technical knowledge versus practical knowledge. His is more of a science. You might disagree with this characterization. His is more of a science. Mine, I would say, is closer to an art. It's closer to songwriting. People don't invest rationally, and you have to resolve that tension. Um, and sometimes you got to finagle and you got to work around and get a little creative to do that for people. So let's just hop into the video. This is why income investing will not give you income. And I'm an income planner primarily, so.
In my last two videos, I talked about high-yield bonds and preferred shares. These are two alternative asset classes that investors venture into when they're seeking higher income yields. I told you why you might want to avoid those asset classes. Today I want to tell you why focusing on investing to generate income is a flawed strategy altogether, and why a total return approach to investing will lead to a more reliable outcome.
Okay, so right out the gate, I agree with Ben here. For income purposes, we typically would not we would not recommend pure investing. It's just too dangerous. I mean, around here, South Texas, a lot of people are retiring with maybe 200 to 1.5 million, which in 2025 ain't what it used to be, and it's not gonna return what it needs to, even if the withdrawal rates are really good. Even if you can take out 6% instead of that 4% rule, the cost of living going up just it's going to make it hard. So I already agree with him. Let's see if we agree in the same way, because you can disagree on an agreement.
Investors often desire cash flow from their investments. There are blogs, books, newsletters, and YouTube channels dedicated to income investing. Income investing means building a portfolio of dividend-paying common stocks, preferred stocks, and bonds in an effort to generate sufficient income to maintain a desired lifestyle.
Yeah, that's a good point. People don't think about this when they're working, and when they're still in the workforce and they're in the accumulation phase, and they're just going to that refinery, clocking in, clocking out, contributing to their 401k, to their retirement. They're not thinking about streams of income after they lose that job, after they leave that job. They're thinking all growth, and it's really hard for some people to get out of that mindset. But think about it this way. If you had the Mona Lisa, if you were in possession of the Mona Lisa, and it cost you $10,000 a month to live, and your Social Security is getting you $2,500, but that Mona Lisa is growing at 19% a year over year reliably, what good is that Mona Lisa to your ability to pay for the car note, to go eat, to go on vacation, to have Christmas with your family? An appreciating asset in this phase of life that I work in retirement, it's not very useful. It's great to have if you can take income off of it reliably and safely. That's awesome. That's the ideal scenario. Everybody wants principle to stay intact, and you just whisk off the growth as needed. But in a world now where a tweet can tank the market, and one Fed meeting can lower or raise the market in real time 6%, it's hard to pull that off and time it right. It's a little treacherous, so let's keep going.
The idea is that if you have enough income-paying securities in your portfolio, you will be insulated from market turbulence and can comfortably spend your dividends and coupon payments regardless of the changing value of your portfolio. There is a perception that if you never touch your principal, you won't run out of money.
Let me just, this is an aside, but my fiance, we were at a corn dog stand in town one day. I just moved in. She was showing me the best corn dogs where we live. I pulled my card out and she said, no, 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 I have cash. She said, if I spend cash, then we didn't really spend money because the bank account number didn't go down. So it's funny how we see things. We're not natural bookkeepers.
It seems like a foolproof retirement plan, but is it? Really? I'm Ben Felix, Associate Portfolio Manager
Is that a little
at
attitude?
PWL Capital. In this episode of Common Sense Investing, I'm going to tell you why income investing will not give you more income.
Let's see what he thinks income investing is. I'm sure he's more technically correct than me.
This video is in response to a question from Joey, who contacted me by email. Let me start off by saying that there is no evidence that dividend-paying stocks are inherently better investments than non-dividend-paying stocks. There are 5 factors that explain the majority of stock returns.
He's already attacking dividends.
Are not one of those factors. For example, we know that if you gather up all of the small cap stocks in the market, they will have had higher long-term returns than all of the large cap stocks in the market. Based on this, company size is one of the factors that explains stock returns. The same evidence does not exist for dividend-paying stocks. If they aren't inherently better investments, why do people like them so much? In a 1984 paper, Mayer Statman and Hirsch Schefrin offered some potential explanations for investors' preference for dividends. If they have poor self-control and are unable to control spending, then a cash flow approach creates a spending limit. They will only spend income and not touch capital.
Okay, I feel like maybe that statement, maybe it's because it had the word poor in it right at the beginning. I feel like that statement had a little stank to it. And I don't think, let me go back to that quote, I don't think there's anything wrong with this. I think it's a good thing if you realize that you don't have the amount of self-discipline needed to do a thing, and you create a solution that is self-limiting. It would be nice if we all had perfect discipline. I'll give you an example with me. I do keto. I get so much blowback on that from my sister, who's a nutrition major. I do keto around summertime, around vacation time, because I'm trying to drop a couple pounds quick, and you feel great. It's not, I know, the reason I do that is because I know I personally am not capable of a balanced diet, a calorie deficit. I can't do that. I know even if I start off good, even if I'm eating potatoes and rice and whole grain bread, that eventually, inevitably, it will devolve into 2 pizzas a week, fried chicken, getting my protein, and blizzards at DQ. So me doing keto, I drop 20 pounds in a month in extreme cases, and it's basically what this is. I'm limiting because you can only eat so much steak at a time. You're not going to overeat steak. You can eat pasta to the point where life is miserable. I'm getting away from the point. The point is, if it works, it works. It doesn't have to be optimal. We're human. We're not rational as much as we like to think. I have engineers come in. They lay out their finances, and I see some of the most irrational things because what they're doing is they're using their engineer mind to rationalize what is just a preference and not necessarily optimal in the investment space. So all that, let's circle that back around to this quote. I don't think there's anything wrong with this. It has a negative connotation, I feel, but if it works, it works. That's the most important thing. Does it give you the desired outcome?
Creates a spending limit. They will only spend income and not touch capital. Another explanation offered in the paper is that people suffer from loss aversion.
Mm-hmm.
If their stocks have gone down in value, they will feel uncomfortable selling to generate income.
On
the other hand, they will happily spend a dividend regardless of the value of their shares.
People always want the free lunch. That is funny that if I have a client that is in just an ETF portfolio producing no dividends, and it tanks like it did. It's June 2025 as of recording this. Liberation Day was the beginning of April. Nobody was taking money out of the market. Nobody felt comfortable doing that. That would have simply added to their nausea. But if they did have a dividend, I bet they would have taken that thing to Burger King. I bet they would have taken that to Papacitos or something, because we really want the free lunch, even if it doesn't make any sense, even if we're just changing numbers, if we're just putting numbers into different columns and the net loss is the same, as long as it feels free, in our mind, it's a license to spend.
There's a problem. As much as a dividend may seem like free money, the reality is that the payment of a dividend decreases the value of your stock. If a company pays $20 million to its shareholders as a dividend, the remaining value of the company has to decrease by $20 million.
People want to fight that.
The investor is no better or worse off whether the company that they invest in pays a dividend or not. This is known as the dividend irrelevance theory.
Now, I think what Ben here is talking about is dividends, because I've seen another one of his videos on dividends. We might watch that. I like this guy. I don't want to overdo it, but I like his channel a lot. You should go check it out. But I think what he's talking about with dividends is dividends as an indicator that the company will perform well, that the value of the stock will go up by virtue of it having a dividend. It's so confident that it can give you money. They have to do well, right? I heard Warren Buffett, he's not in the Lord and Savior of investments, but he's pretty close. He said if a company's paying a dividend, they just don't know how to reinvest their extra earnings. But that's not the point. The point is, the way I think of dividends, the way Grandma told me about dividends in the checkout line of a grocery store while she was writing the check for her carrots, the way she explained it was, in bonds, is you live off the yield. You live off the dividend of the stock, and you live off the yield of the bond. He's talking about dividends in terms of a value indicator, of a future growth indicator. But in retirement and in income planning land, I think of it as a source of income. And I don't know anyone. I could be. I know they're out there, but I have never met anyone in my life. 7 years doing this, even longer being in this space. I don't know anybody really taking a substantial chunk of income from dividends in retirement. It just doesn't happen. I'm sure they're out there. I bet maybe they're all up north or something. But around here, I'll see dividends, but the client can't tell me why they have dividends in their portfolio. It's not like a strategy. They're not trying to optimize dividend behavior. It's just there. They're not really using it for anything. It's just, it's a diverse portfolio. Why did you pick this thing to diversify? What? I didn't pick it. So,
which originated in a 1961 paper by Merton Miller and Frank Modigliani. I have just told you that whether returns come from dividends or growth does not make a difference to the investor, but there is an important detail for taxable investors. There is no difference whether returns come from dividends or growth on a pre-tax basis. On an after-tax basis, the investor without the dividend is in a better position because they could choose to defer their tax liability by not selling any shares if they don't need to cover any spending. The dividend investor is paying tax whether they spend their dividend or not. This is a big problem for an investor who does not need any income at that time. About 60% of U.S. stocks...
Yeah, there's a lot of people. You'd be surprised how many retirees, especially when they hit RMD age. That's the age the government makes you start dumping money out of your retirement accounts, your IRAs, 401ks, all that, because they want their tax money. There's a lot of people that don't want the extra income. The money they have to take as income out of their retirement accounts is more than enough to suit their lifestyle. It's above and beyond, and all it really equates to is less growth potential and more taxes. So that's a good point. If you got to assess where you're at, and if you want that on your tax return, if you want that extra income, the dividend income on your tax return.
Stocks and 40% of international stocks don't pay dividends at all. Investing only in the stocks that do pay dividends automatically results in significantly reduced diversification. Dividend investing can also lead to ignoring important parts of the market. There are plenty of great companies that do not pay dividends. Ignoring them because they do not pay a dividend, which we now understand is irrelevant to returns, is not logical. A good example of this is small cap stocks. An income-focused investment strategy will almost certainly exclude small cap stocks, few of which pay dividends. Now, don't get me wrong. Dividends are an extremely important part of investing. $1 invested in the S&P TSX Composite Price Only Index, so excluding dividends, in 1969 would be worth $14.37 today. The same dollar invested in the S&P TSX Composite Index, which includes dividends, would be worth $64.59. If you are investing in Canadian dividend-paying companies, you also receive favorable tax treatment on your dividend income. Dividend-paying common stocks are an important part of your portfolio, but a dividend-focused portfolio leads to tax inefficiency for taxable investors, poor diversification, and missed opportunities.
Yeah, I just think unless you really like the company, independent of the dividend, there are better ways to generate income, far better ways to generate income than dividends. You know, they can suspend dividends, right? They could change, they have full unilateral autonomous control over how much or how little a dividend payment is. So it's not like a guaranteed income. We do a lot of guaranteed income. Ben here would probably disagree with that. There's a lot of people that would. But I haven't seen anything work better. If I knew something that worked better, I would pick that. But anyways, that's, again, getting off topic here. But yeah, dividend-focused portfolio, that's odd. I haven't seen that in practice. I have a lot of people, by the way, come in from other advisors. And I see dividends in there, but it's like a negligible part of the portfolio. But I'm sure these people exist. I have some clients that do some very odd things that work. They work well. They only do fixed CD type things. And hey, if the strategy works for you, there's nothing wrong with it. That's my general philosophy. But if you're open to something better, there usually is something better. If it aligns with your temperament.
A total return approach, accomplished by investing in a globally diversified portfolio of total market index funds, results in greater tax efficiency, better diversification, and the ability to capture the returns that the market has to offer. The topic of dividends tends to get people very excited. Dividend investing is almost more of a lifestyle than an investment philosophy.
Yeah, it's kind of like, this isn't a one-to-one, and I don't want to denigrate because there's totally legitimate dividend strategies and there's totally legitimate crypto strategies, but it's kind of like crypto bros, if you want to call them that. I know there will be people that have maybe $2,000 worth of dividend stocks and that's all they talk about. That's the crown jewel of their investment account is the dividend stock, and it's not doing anything substantial for them. They could have way beat that by having Amazon or something. But they love it, and they talk about it, and it spits out this dividend, or either reinvestment, or I take it to Cracker Barrel. So, yeah, and that's okay. There's nothing wrong with that. I think where the problem is if you're so into that, like if you just like dividend stocks and you want to talk about them because you want to sound like you know all about dividends and that you got some strange edge on whoever you're talking to, that's fine. But I think it becomes a problem when you start blinding yourself to the fact that you could have done better. It's okay to just say, I like a dividend stock. I know what I'm leaving on the table, but this is what I'm familiar with, and this is what I'm like, and this is what I'm comfortable with, and this is what I'm going to do. It's okay to think that way. But if you're kind of clinging to the thought and you're ignoring other factors that would indicate otherwise than how you're thinking, we should maybe address that. A lot of the job on my end, I don't know about his end, a lot of the job on my end is kind of like money therapy. It's like financial psychiatry. It goes to some odd places. We go to some strange, deep places, some childhood memories to figure out things about money in the client's 60s.
I would be happy to hear your thoughts in the comments. Join me in my next video where I will tell you why.
So I guess that's it. Short video. I don't know how short it is with my added commentary, but yeah, this has been Not Your Financial Advisor. It's my new reaction segment. Sure, it's kind of lazy, but it gets the juices flowing. It gets me thinking about things to talk about with the clients. So I hope you enjoyed. This microphone is purely for show. It's not on right now because I can't get the headphones to work, and it would just double the audio. But I will see y'all in the next video. Thank you for watching. Take care.